Hey everyone, it's Zach back with a new mortgage video. Hope you're all having a happy Thursday. If this is your first time seeing one of my videos, welcome to my channel. If you're a returning viewer, welcome back, where I'll try to demystify all things mortgage related. If you find this content helpful, please like and subscribe. So today I wanted to give a quick market update. Since my last report, which was right after the CPI report was released for April, the market has kind of gone up and come back down to basically where we were right after that report, which is kind of how it should be. Things going on worth noting. There has been a little bit of softening on the job front. So as I've said before, inflation coming down is the one thing that will for sure prompt the Fed to start cutting rates. However, if the job market starts to worsen, that could prompt them to start cutting rates before they would ideally like. So we're definitely not at that point yet. However, we are seeing a little bit of softening in both the initial jobless claims. We had a report this week, ADP employment, showing less jobs created than expected. Tomorrow, we will have both unemployment and another job openings report. So I'll be looking closely at those numbers. Right now, the market and myself are 100% sure we're gonna have another rate pause in June. However, July, the market sees as very likely to be another rate pause. It puts the probability of a rate pause at, I think, 83% as of today. I think while it's still more likely to be a rate pause than a rate cut, I would put the probability more like 30 to 35% of a rate cut. I see two scenarios that could prompt a July rate cut. One, we see employment continue getting worse. Unemployment going up, job openings, job availability going down to where there is a real fear of a recession, and that combined with inflation at least coming down a little bit, even if it's not dramatic, I think that would prompt a July rate cut. Or, and I think this is the more likely scenario, if we see kind of the same trajectory of jobs where it's softening a little bit, no longer this crazy inflation-driven job growth, combined with two good inflation reports, I think that would prompt a rate cut. Because I think that there's a good chance we could see at least mixed inflation data in the next 2 months. That's why I'm still saying it's more likely we have a rate pause than a rate cut. But I think the market is overestimating the likelihood of a rate pause in July. And then September, that's where I think right now it's almost certainly going to be the first rate cut. And until we start seeing really shelter, the thing I talk about the most, if we start to see that still staying flat in the summer months, starting with June CPI and PCE, if that's not coming down, then I'll have to recalibrate my expectations. But right now, that's still when I'm expecting overall inflation being led by shelter to start really coming down, when the rents that are being renewed will trickle into that shelter index and start to make a real impact. As always, the next CPI report is going to be the big date to remember. And in this case, it's not just CPI, but June 12th is the day to remember. We both have CPI and the Fed's next rate decision, which again is going to be a pause. However, it's not just any rate decision. They're also going to announce their dot plots for the rest of this year, as well as 2025, 2026, 2027. Essentially, this is the Fed's members predicting what they think is going to happen with inflation and with rates for the next few years. And while in December, the market had projected there were going to be 6 rate cuts in 2024, the consensus Fed belief was that we'd have 3 rate cuts. Then in March, there was still a consensus majority thinking 3 rate cuts in March. However, it was much closer, between 3 and 2 rate cuts in March. So it'll be very interesting to see what the Fed members think in June, what the rest of the year is going to look like. Generally, they've been, in my opinion, a little more accurate recently, at least, than the market. So I'll be curious to see. I think Jerome Powell has mentioned before about shelter and the expectation that I voiced that in the summer months, we're going to start to see that number come down and bringing inflation down, and the lagging effect that is natural with that metric. So I think that is going to impact their projections to where they're going to expect more rate cuts this year than the market may. And the other thing that they're going to project in this June meeting is PCE core inflation, which is the Fed's preferred measurement of inflation. In December, they had that number at 2.4%. In March, they had it at 2.6%, still projecting 3 rate cuts, even if it ends up only at 2.6% by the end of the year. I'll be curious to see where they have it after this meeting, knowing that core PCE right now is 2.8%, but it's stayed flat at that number for the past few months. Anyone that is considering buying a home, I would say don't wait for rates to drop dramatically, because even if we get a Fed rate cut in September, I don't think that's going to dramatically change mortgage interest rates. It's really going to be 2025. I could potentially see a real change in interest rates. So definitely look at your options based on the current market interest rates. Look into temporary buy downs if you want a monthly payment that's a little bit lower for the first 2 or 3 years, depending on how much you can get in seller credits. And if you're going to do that, you want to keep track of what's going on in the market so that you can refinance ideally before that temporary period ends. As always, if you have any questions or comments, shoot them below, or feel free to call, text, or email me. But thanks for tuning in to this video, and I'll see you next time.